So for the benefit of the introduction, we have a number of investors and potential investors in Rubrik funds. Stephen O'Hanlon is the CIO of the business and has been running money since God could remember. And I think that the topic of today, which is very important to address, is the topic of inflation, the movement in rates, and the uncertainty of global central banks being more dovish or less dovish than usual, and the implication that this move could have on the fixed income global markets, which translate then in the two main strategies managed by Rubrik, which are a strategy of global credit and a strategy which invests both in credit and rates. They also run an emerging market product which invests both in rates, credits, and currencies. I open the floor to the Rubrik professional. Steve, to you.
Thank you very much, guys. There's so much in that topic that Luigi just mentioned that we could be here for about 3 or 4 hours. Most of our lunch times do get spent talking about these topics, and it does go on for a while. So we'll try to keep it as concise as possible, but please ask questions, if there's something comes up that interests you or you want more clarity on. But there's two sides of the equation we'll just deal with first of all. And one is what the economic outlook looks like over the next 6 to 12 months and how that plays into our interest rate inflation outlook going forward. And just very simply, our economic outlook over the next number of months is, as with many people, very positive over the next few months from the pent-up demand, the fiscal transfers, hopefully specifically in the US, the vaccine take-up has been pretty good, and we should have more and more immunity in the US for states to reopen. Now, having said that, as we've seen in Europe in particular, there's going to be other outbreaks of COVID and other increases in cases, but in general, it seems to be in the rear view mirror. So in terms of the base effect of last year's economic activity and all that stimulus and all that basically pent up demand, numbers should be pretty good over the next few months and maybe to the third quarter of this year. But I think something very important we'd like to talk about in terms of the growth numbers, and one is that the main source of growth going forward over the next few months is definitely going to be the US. The US is going to be somewhat standalone in terms of, Europe is not going to have the type of reopening as we've just mentioned now, and doesn't have the same scale of fiscal support that we see in the US. So Europe will underperform. Growth will be good, but it certainly will underperform the US. And China, which is also a really important component here, which will play into our inflation view later on, is also not going to be a massive supporter for a large growth number for quite a while. So really the US is going to be the main driver. And that means that sugar high, and I call it a sugar high, that we're going to see over the next couple of months is going to be a fairly short-lived thing. I mean, a lot of the fiscal transfers that we're seeing are very much consumption-based rather than investment-based. So a lot of the push forward will be on, services reopening, people going to Disney and all these type of things. Certainly, going out to restaurants and maybe going to the cinema or whatever. I think everyone dying to see the new James Bond movie that's been waiting for 2 years to get out to the cinema and see it. But, that's going to be very much a kind of one-off thing. Pent-up demand for services is very different than pent-up demand for goods. We spent a lot of money on goods over the last year, people buying a lot of things for their house, etc. So it's really services that we see a pent-up supply demand for. And of course, there's going to be somewhat limited supply in some cases because a lot of small businesses, service-based businesses, just won't be able to reopen. They've closed down permanently now. In the US, for example, we're looking at between 20 and 30% of restaurants not reopening post-COVID. So there's going to be a bit of an impact there going forward. So overall, we do think we're going to have some really strong economic data. We're going to have, some pretty high inflation numbers to boot, partly because, as I said, the supply side issues, and there will be higher inflation numbers coming through, and there will be some strong jobs data, certainly initially, for the next few months. However, given all that and what we've seen in the past, we do think that there will be a fairly significant roll-off of economic activity come the end of the year and early next year. And there's a large number of reasons for that, but mainly around the COVID scarring, the continuous unemployment rates, which will be higher than what most people would be happy with, and of course, the fiscal transfer boom will slow off. So I think it's very important to kind of look at a situation where come midsummer, I think there's going to be a lot of Wall Street houses predicting, a trend growth which is much higher than what actually is. And what we've seen over the last number of years is that when we have had stimulus programs like we had in 2017, you do have that kind of jump off trend growth, stimulus growth, and then all of a sudden it reverts back to trend growth. So I think by the end of the year, I think we're going to be moving back towards we're closer to trend growth in the US, which is back towards sub 2% growth. The issue now around inflation, again, very interesting, and this is a very difficult one to answer, because I think it's fair to say we have seen somewhat of a regime change, and what I mean by that is the economic orthodoxy of using monetary policy alone to support growth over the last decade or so has moved on tremendously to a situation now where we're seeing fiscal policy being the real driver of economic growth, certainly from a policy perspective. And it's really interesting looking at the changes we've had since the 1990s, where post-Reaganomics, we had people on the left, like, for example, the Labour Party in the UK, the Democrats, moving more to the centre with the likes of Tony Blair and Bill Clinton, who very much could have been, Bill Clinton could have easily been a Republican president for the way he approached things, and the same could be said about Tony Blair in the UK. However, what we've seen over the last couple of years, and certainly over the last 12 months, we've seen a move where the right is moving more to the left. So in the 1990s, it was the left to the right. Now we're seeing politically a big move on the right to the left. And you can see that in terms of where Trump took the Republican Party in terms of spending and things like that. So if you also look at the popularity of the COVID relief bill, even amongst Republicans in the US, it's fair to say that the Tea Party is dead and buried in the US, and that economic orthodoxy has moved from just a monetary idea to one in which we now believe, and we can take this to the IMF and everywhere else, that fiscal policy has to play a tremendous part of the recovery from the COVID pandemic. And I mean, this is a real mood change, if you like, from what happened post-GFC. And a lot of the people who are in the White House at the moment are people who were around the Obama administration, who do feel that the fiscal policy component left things behind. But I think it's important to say that back during Obama's administration, monetary policy had a fair bit to offer. They did introduce the QE programs, they did keep rates very, very low, and there was a lot of activity, certainly from a top-down approach, or like they call a trickle-down approach from monetary policy. But monetary policy has pretty much shot all the bullets that it had, and even the Fed admitted in October 2019 that monetary policy did no longer have a big impact on economic activity, while still having a significant impact, certainly on capital markets. Now, of course, we're now looking at an environment where, you know, the regime change is one where fiscal policy will be driving economic solutions and monetary policy will be playing a role in support of that. So we're getting pretty close to that MMT, as some people call it, the magic money tree, or some people modern monetary theory, which is obviously nothing modern about it, that, you know, basically, you know, Biden's going to look to use fiscal policy very aggressively, and he already has. Now, there's obviously talk about taxes, and Elizabeth Warren is talking about wealth taxes and the top 1% and anyone earning over $400,000, increasing the overall tax take from them. But in general, it looks like the Federal Reserve will be the one sponsoring a lot of this fiscal spending, certainly in the near term in the US. So where does that leave us with inflation? Because it's quite interesting. In many ways, monetary policy drove deflation, not inflation. And it's quite a complicated story, but I think what we've seen is what monetary policy did, in essence, would added a lot of debt to the system. It did not incentivize at all investment in the real economy. And it just meant that in some cases we had excess supply and demand function wasn't driven that high in the real economy. So we didn't really have a big jump in inflation. And one of the things I think a lot of people looking at inflation would always look at is not just the M2 number and the money supply, but also very importantly, what the velocity of money is. And as you know, as we saw over the last decade, the velocity of money absolutely collapsed. So it didn't matter how much money you pushed into the system through the central banks, a lot of that money just stayed on bank reserves and never found its way into banking deposits. And that was the key component. We never had a real inflationary moment because none of that money was basically trickling out of the financial system into the real economy. And you could see that through the velocity of money. So to see a situation where all that monetary activity was going to create inflation, you had to see a situation where the velocity of money picked up, and it just didn't. And bank lending, to any great extent, didn't pick up. And where we did see credit expanding, a lot of the credit expansion we saw over the last decade, a lot of that went into things like share buybacks. And that's why I think the most important factor here was what incentives did we set for the economy going forward. And we didn't set very good incentives. In fact, the incentive for the economy was buy back your own stock and the Fed will help push your share price even higher. And the management and the top 1% would do really, really well. So that was a major, major problem. Now let's move on to what does this mean for inflation going forward? Have we changed the incentives tremendously to create inflation? Are we going to start creating bank deposits rather than just bank reserves? One of the things we did over the last number of months is we look back at a couple of incidences where we had large fiscal expansion. And you know, the obvious case in point is to look at, for example, the New Deal, Roosevelt's New Deal in the 1930s, and to see what kind of impact that had. And it was interesting, we did come across one poll which showed in 1939, 66% of Americans felt that the New Deal actually kept private businesses from expanding and actually was a headwind, not a tailwind. And of course, in 1939, we still had 20% unemployment in the US. So even though some progressives would look at the New Deal and say it was not a great thing, in itself wasn't as effective because it didn't set the right incentives. In other incidences, fiscal policy really worked very well. I mean, you can look at, for examples like Star Wars, Reagan Star Wars programs, and even the space race in the 1960s, where there was tremendous private-public partnerships, which actually created a lot of technologies which the private sector was able to use then moving forward and earning a competitive advantage globally. So there are different ways of looking at how governments can work with economies to create further growth and healthy growth. And what it really comes down to is structurally, it's very, very important to know how Biden and his team are looking to use these programs outside of just basic fiscal transfers, which are basically just consumption support rather than any investment support for future growth. So we've read quite a lot from different strategists over the last number of months. Some of them have been, again, the people who believe in the deflation story. And there's been some people out there who've looked at the M2 and said, M2's at 25%. 40% of all money in the US has been created since 2020. Of course, that's going to create inflation. The one thing I would absolutely say right now with clarity is that we don't have enough information yet as to know if we can turn this situation into an inflationary situation as opposed to a deflationary situation. And the reason for that is we won't know till we have the next slowdown. We won't know till 2022 if we're going to turn these fiscal transfers to a permanent thing, right? So when we had the QE programs in 2008, they pretty much became a permanent part of life. Every time growth disappointed, another QE was announced, or a QE twist, or whatever you want to call it. But in essence, it never stopped. The question now is, are we going to have more fiscal transfers in 2022? Or are we going to have investment and we're going to focus only on investment, or is it going to be more and more handouts? And that's a very difficult one to answer at this stage. So I think the fair scenario to suggest would be that after the boom in inflation that we're going to have over the next 4 or 5 months, it will subside. You will see in about 3 or 4 months' time, things like industrial metals starting to roll over. China will, as a marginal buyer and a majorly important player with marginal growth globally, start to slow down, which we're already starting to see now, by the way. And that's going to be a massive headwind. And after the sugar high that we get, and that the restaurants start charging you, $50 just to book a table, let alone have a meal, once that supply side issues get cleared up and that people can get their semiconductors for their autos, for their manufacturing, et cetera, we do think that the gravitational pull of the debt that we've built up over the last 12 months is going to be quite significant. And what I mean by that is, the more debt you have in the system, the more the gravitational pull you have on inflation to become deflation. So debt is probably the biggest deflationary force you have, because the more debt you have is the further you have to run just to service and pay back that debt. Now, even at low interest rates, the extent to which we have now added debt to the system, and certainly if you look at US corporate debt right now, it's an incredibly large drag on the system. In fact, right now, the US has about 20% zombie companies, which is pretty much the number that we got to in Japan, which caused this massive problem in terms of growing and creating real productivity growth. Now, Rajan, the economist Rajan, chief economist of the Chicago Business School, and Draghi, our favorite central banker from the ECB and now Prime Minister of Italy. Great thing about being in Italy, you don't have to actually get elected to become Prime Minister. So that's pretty super, Luigi. You might be up next to be Prime Minister. They wrote a very interesting piece recently about, if you want to see real growth happen in your country, you're going to have to let bad businesses, or as we'd say, analog businesses, go bust, because we now live in a digital world. Monetary policy today tells you they're not going to allow that to happen, right? So right now, any business can just get debt, can basically stay surviving, certainly big businesses. And at the moment, we've got 20% of US corporations staying in business purely from basically borrowing money. And that seems to be the model they want to stick to, certainly during the pandemic. But we've got massive debt overhang. We have got basically a huge zombification of the US economy. 20% is a big impact overall. So the really successful businesses will have to grow even faster. And as we've seen, we've saturated the growth that we can possibly see, by the way, in the larger companies like Amazon and Google. They're already at such a size right now that even a small percentage of growth would be a massive undertaking. So there's a lot of headwinds right now. And as I said, that gravitational force of debt in the system is going to drive inflation down. However, it really depends ultimately on what the policy changes will be over the next year or so. We haven't seen enough right now to say with certainty, because those financial reserves that we have in the system have not translated yet into deposits, right? They have not translated into a higher velocity number in the system. So without an explosion of credit in the system, and a system that, by the way, is already heavily indebted, seems an unlikely scenario right now, and that there's going to be considerable scarring from COVID, the likelihood is the strong inflation numbers we're going to see over the next couple of months will dissipate pretty quickly. And it's interesting, if you look at the bond market right now, if you look out beyond 5 years inflation expectations, there's certainly a drawing down of inflation expectations over time. But my view would be, for all those people who think there's going to be inflation, we still have yet to see what the policy response will be to the next slowdown. And that will tell us a lot about how they're going to deal with it. And one of the signs that we're probably going to see that will inflict more inflation on a system in the US would be something like YCC. So if the US Fed decides, right, we want to have a high inflationary environment with low interest rates, and they say, look, we're going to start now targeting 10-year treasuries at 1.5% or whatever it is, that again could be an area which we could basically import inflation by having the dollar to weaken. The dollar hasn't weakened yet because actually real yields in the US aren't that low relative to other countries. But a YCC program could potentially take the dollar much weaker, and that's obviously yield curve control. And that in itself could be the start of a weaker dollar, which would then be much more inflationary. And that's where the hyperinflation scenarios would happen. So I think a YCC scenario in the US would be your first telltale sign of it happening. What's really interesting that's happening today in the bond market is the Federal Reserve has not said anything yet about interest rates, right? The Federal Reserve have not said they're concerned about raising interest rates. And one of the reasons for that is I think financial conditions are still very loose, and the Fed is quite happy to have the yield curve steepen where it is, and certainly to the point where it's not really affecting things like credit spreads. So I think, you know, if anyone's expecting the Fed to step in to actually start to kind of manage the yield curve in the US, one of the telltale signs for the Federal Reserve will be any impact we're going to see on the credit markets. So at the moment, the rising of rates has not impacted the credit markets. And everyone is writing these articles saying at 2%, at 225, at 250, what's the number? What number is going to affect the credit markets? And there really isn't an exact number. What is actually going to affect the credit markets, and when credit will really start to spreads will start to widen, is not at a particular number for the interest rates, but when growth disappoints. So what we've continuously seen over the last 50 years, but in particular the last 10 years since 2008, we've seen a scenario where interest rates have gone up on a numerous occasions, but it really is the drop in growth which basically ignites the tighter financial conditions and the spread widening. So our view would be over the next 3 or 4 months, it's not necessarily the story of 2%, 225, 250 on the 10-year. It's more to do at what point does that ultimately impact growth, and at what point ultimately does the sugar high of all the fiscal stimulus wear off. And that's a really interesting point, because all this fiscal stimulus is going to do is potentially, and I'm just saying potentially, allow interest rates to basically go higher than what we would expect the equilibrium for interest rates to be. So that actually financial conditions are going to be very, very loose. There's a lot of checks going to a lot of bank accounts in the US, and for a couple of months over the summer, with the high GDP numbers, the high growth numbers, and potentially the high service numbers, so the PMI services could even get higher than we're seeing today, you might have a lot of cover to allow interest rates to continue to rise. What will happen when that sugar high ends is that as the growth starts to roll off, people realize, oh wow, interest rates have gone too high, and then financial conditions will actually tighten quite a bit. And that's when actually we start to see credit spreads start to widen. And by the way, that has pretty much been the story every 2 years for the last decade. That could be, we can discuss what happened in 2018, what happened in 2016, what happened to the taper tantrum, what happened to the European banking crisis, 2010, and even 2008. That all those incidences where we had a bit of a jolt to the markets, we're always being quite concerned as a marketplace at what level interest rates are at. But it's the real science of knowing when growth will be impacted. And what we had, for example, in 2018 was a scenario where the ECB was doing lots and lots of QE, which was a lot of cover for what the Fed was doing in terms of QT. And it wasn't until European QE came to an end that actually that tightening of financial conditions happened and growth got impacted. This is going to be pretty much the same thing. So I think over the summer, we could see a situation where a lot of strategists get overly bullish on economic conditions and overly bearish on inflation, and that will allow rates to go potentially higher than it potentially should do, given where trend growth really is, and that we could have a big disappointment in the fourth quarter, first quarter of next year. So our view at the moment is certainly one to which I would be concerned over the medium term, depending on policy decisions, what will be the long-term outlook for inflation. But certainly in the short term, it is boom bust, which looks to be the most likely outcome. And then it's the response to the next bust that we think will be very, very interesting. Sorry, Killian, did you want to just have something more? Because that was quite general and particularly around US inflation. Killian, do you just want to have a little bit on the European inflation outlook?
Yeah, thanks, Steve. Yeah, so Europe is facing a pretty different outlook to the US. So there's some similarities and there's some differences. I guess the similarities are as the economy reopens post-COVID, we will get some inflationary pressures, and there'll be the same supply side pressures that the US is facing from increased shipping costs and from closed factories and increases in commodity prices, etc., which will see a boost in inflation over the next couple of months in the US and in Europe. The problem for Europe is that we're getting a boost from a lower level and to a lower level. So even with a predicted increase in inflation over the next few months, the ECB is going to be well short of its inflation target, which is not the case for the US, where they're predicting inflation is going to exceed the inflation target over the next couple of years. So the ECB has a very different outlook to the Fed, and you can really see that from the reaction that we've had from the two central banks to recent market moves. So the Fed has been, as Steve was saying, the Fed has been quite content with the backup in yields and saying that's actually driven by an improved economic outlook, so that's all fine. The ECB, very much not so. The ECB have looked at the kind of move in real interest rates that happened in sort of February of this year, where the rate on, say, if we use the 10-year German real yield as a proxy, that went from sort of minus 165 all the way up to minus 130 or so. The ECB was not happy with that type of tightening of financial conditions by an increase in real yields, and so they came out, and there was quite a lot of jawboning from the ECB. We had Philip Lane out, we had Lagarde out, and lots of other speakers out saying that they think some of this move in real rates is unwarranted. And the culmination of that, I guess, was the fact that the ECB at its last policy meeting has decided to increase its bond purchases to kind of negate what it calls the unwarranted increase in yields. That has a number of effects on the markets. I mean, the most obvious one is that euro-denominated bonds are likely to outperform their US counterparts in the coming months. So bonds are probably going to fare better than treasuries in the near term. The most obvious place to see it is in the euro, really. If you look at where the euro was going a few months ago, it looked like it was on its way to 125 and possibly beyond. And ever since, we've had this kind of split between the Fed and the ECB and how they're reacting to the inflationary pressures in the different economies. The euro has fallen and is now just back below 118. So it's a very different situation in Europe, where they're not as happy to see yields rise as the Fed is in the US, and therefore there's going to be a different reaction from the central bank and a different outlook for yields and for inflationary pressures ultimately in the economy.
So I think that's pretty important. I mean, the outlook in January, if many of you remember, was everyone was very, very bearish on the US dollar. And by Powell stepping back and allowing US rates to go uninterrupted, if you like, certainly without any talking them down, rates go higher. Real yields have actually tightened a lot more than what we've seen in Europe. And there's a big gap now between real yields in the US and real yields in Europe. And that really is very euro bearish. So I think that's a big change in terms of the currency outlook that we're seeing. And one of the concerns that you always have when you're looking at inflation is currency moves. And many of you, certainly Luigi, will remember the extent to which we saw inflation in the UK post-2008 after the big debasement in the pound. And I think currencies have a big swing factor when it comes to inflation as well. So certainly in the US, a slightly stronger dollar certainly will also be a slight headwind to long-term protracted higher inflation numbers. But certainly we're not seeing any kind of swings yet that would actually push inflation one way or another. Certainly the debasements that we've seen in the UK are much larger than what we're likely to see in the Eurozone or the US for the moment. But certainly you'd be more bullish the dollar versus the euro now, or sterling, going forward after a couple of months where there was high expectations that the dollar would slide. And certainly Powell has allowed that tightening of real yields, which has supported the US dollar, certainly for the moment. But certainly if you compare the US dollar, for example, to real yields in China, for example, real yields in China are actually, quite considerably positive. And again, you're seeing a lot of capital flows into China right now. You saw a very strong Chinese renminbi yuan over the last number of months, bases around, a much higher real yield. So for the moment, that kind of important trade is actually not for a much weaker dollar, which was very supportive, by the way, in the reflation trade that we were hearing at the end of last year. And what's really interesting about the markets today, and something that we talk about most afternoons, looking at market volatility, is we've really moved, which we saw in the fourth quarter of last year, which was pure reflation trading, right? So there was a lot of, everyone was basically talking about betting on the reflation trade and buying assets like that. We've actually jumped around a little bit in the first quarter between a reflation trade and an inflation trade. So, some days the markets were very much, you could see just from the price action across the board on different asset classes, the markets were very encouraged by reflation. And then, of course, there was moments when rates would actually jump a bit higher. And then there was concerns on inflation, which weren't obviously as positive as other periods. So anyone who's trading, obviously, things like equities, they're seeing a lot of rotation around growth and value, etc. And that's been quite a volatile trade. But that's really because the reflation inflation trade has been kind of jumping back and forth over the last couple of months. The real interesting thing over the summer will be, when we see these high growth numbers, will this continue to be a reflation story, or will there be concerns of the inflation story? So I think one of the things we'll probably see over the summer is a little bit of volatility around risk assets, that it's not going to be a free lunch. If you look at things like emerging markets, even just broad, equity indexes on the commodity cycle, there's going to be a lot of vol. Just pure growth on its own won't be enough if we see a difficult time in the bond market as well, because inflation numbers go up. So when you start hearing about the inflation trade, then that's going to be quite negative for real assets, as opposed to just pure reflation trade. So I think it is very unlikely that the Fed's going to step in anytime soon. And one of the signals you'll get about how high rates can get is rates will keep going up, ultimately, in our view, till credit spreads start to widen. And then once credit spreads start to widen, that's when you'll know the Fed has had its signal that basically financial conditions are getting a bit tight and will start to step in. So it'll be an interesting summer. I think you'll be fairly safe with your risk portfolio as long as you're not seeing credit spreads widen. The minute you start seeing credit spreads widening, I think that's the time where you have to be a little bit concerned, and more concerned certainly around risk assets. But certainly I would expect quite a choppy summer's trading, just because there'll be a lot of ins and outs of reflation and inflation stories. But ultimately, it'll come down to a disappointing growth number, I think, at the end of the year, early next year, which will mean a lot of the hot air will go out of the markets. And there is a chance that Powell will focus on Janet Yellen and say, actually, what Janet is doing is more important than me micromanaging the S&P 500. Now, certainly they don't want to have a big drop in risk assets, which would obviously have an impact in their view on consumption. But I think the focus will be more on what's happening in the real economy than necessarily. You could have a situation, by the way, that we still have non-farm payrolls coming in at 400,000 or 500,000 in a month, but the equity market's being down. I think as long as the equity or the labor market stays relatively healthy, I think there'll be less support for financial assets and more support for the real economy. So it'll be an interesting 6 months. It's not going to be a straightforward trade like we had, for example, in the fourth quarter when we all had the vaccine story and we had Biden winning and the Democrats winning the Senate. It's going to be a far more difficult trade, I think, and there's certainly things like a weak dollar won't necessarily be there to give a lot of cover for risk assets. So it'll be an interesting and volatile couple of months.
So this the other interesting thing. I don't know, Steve, your thoughts would be interesting on this, but obviously we've seen a huge run up in commodities in January and February, looking at copper and oil. But in the last month, we're kind of off anywhere between 10 and 15% in some of these things. I mean, do you think we've seen the high? Or I suppose, look, it's early to call that, obviously, but it doesn't seem to be the kind of one-way trade that it was.
No, not at all. Look, if you actually were to model or graph even just the two between China's credit impulse chart and commodity prices, they're a one-for-one link, right? China is putting the brakes on right now for lots of good reasons. And they're very grown-up reasons. They're very mature reasons what they're doing. They see that they've got financial troubles ahead and they're trying to deal with it. And, you know, from what we've seen over the last 10 years, and we've modeled this a lot over the last 10 years, you know, if China decides to put the brakes on, which they are right now, and certainly they'll be very, very active to make sure things don't go too bad, because July, by the way, this year is the centenary of the Communist Party in China. And, you know, they're certainly not going to want a very, very bad economic outcome during that period. And certainly a lot of commentators on China were thinking they were going to keep things pretty loose until after that particular celebration. But certainly they slowed things down even before that. So there's a lot of views that we were reading that actually they'd allow things to truck along till July. They've actually put on the brakes before that. So, you know, it would be my strong view that we might, over the summer, because of what's happened in the US and discussions on infrastructure and all the rest, we might get back to the highs. But I don't think we'll see any new highs in those metal spaces, things like commodity, industrial metals, because obviously if China's putting the brakes on, you know, that's going to have a big impact. Look, there's a lot of talk right now about a big infrastructure project in the US, and no matter how big the numbers we're hearing today, they're still small fry to what China has done over the last decade. But I think if you look at the makeup now of the Senate, politically, the infrastructure project is going to be a lot more difficult to get off the ground, given what the progressives want to be part of it and what the moderates want to be part of it. So even within the Democratic Party, there's a huge discourse between what people think this program should be. In fact, they even want to drop the word infrastructure from the name of it because so little of that project is now looking like it's going to be infrastructure. So I think politically this is going to be very, very difficult to get off the line, and to see a $3 to $4 trillion program and have tax increases bolt on the side of it just seems really very difficult right now. So I wouldn't be pricing in any shape or form a big infrastructure project which would support these commodities. The other thing I think is very important to say about commodity prices right now, guys, is if you remember what happened to the oil price in March of 2020 when oil went to negative. Part of the reason that was obviously the over-leveraged and the amount of derivatives that sit around the oil market and how much ETF money and all these other things are trying to basically track commodities. I mean, when I started my life back in the early 90s, I was a commodity trader. It was my very first job. And, you know, the people who were trading commodity were actually the producers, the suppliers, and the actual clients of the end clients of these commodities. Today, financialization of the commodity market has really taken off, as it did with the housing market and pretty much every other market. So I do have a concern that prices on commodities can become a little bit like financial markets, where they kind of can run up a bit higher than where the real market should be on supply and demand dynamics, just because you've got a lot of hedge funds and even now ETFs chasing these markets. So I think the volatility of commodity markets, as we saw in March with the oil price, can get quite askew because of the financialization of commodities. When you print as much money as we have over the last decade, and a lot of that just sits in the financial markets, you can see those waves of capital can actually influence prices in a very negative way, and obviously an excessive positive way as well. But I definitely think, James, the China story is a big one to watch, and certainly China is now heading south, and that's not necessarily, the US will keep things together for a while, but it'll be very difficult for them to do it over the medium term if their policy is purely consumption based.
And how do you translate all this macro scenery into both the credit funds and the global fixed income fund, please? Okay,
so sure. So I'll just kind of go back really to 2020 a little bit on the GFI story, just to kind of give you a bit of background. You know, we saw obviously difficult times ahead at the beginning of 2020. And actually one of the biggest concerns we had in January of 2020 was more about the slowdown on the QE programs that were supposed to come to an end in April. Yes, we had the concerns about the pandemic coming in, which for us made, well, at that stage, we thought this was going to be an impact on China. So China going south and having, you know, end of QE in April 2020, that was a reason to be very, very cautious on the markets. And then of course we had obviously the big drop in markets in March, which, you know, GFI did quite well in. We didn't make as much in the fourth quarter of 2020 because two things happened in 2020 which we just didn't model correctly. And one was obviously the vaccines. We did not think we were going to see vaccines with efficacies of 90% plus in November. That really was a tail event. I mean, some people wrote about it, but most of the doctors that we were following at the time were saying that this could take, you know, much longer than a year, and efficacy could be between 60 and 70%, which makes it very difficult to even dream about getting herd immunity if your vaccine could only last for 6 to 9 months. So obviously we got a massive boost then, and we got a massive boost in Georgia with the Democrats winning. So, you know, we obviously had a big slowdown in September, but we had a real big pickup after that because of the vaccines and the Georgia wins for the Democratic Party. Looking how we're positioned now and going forward, our view is the pressure is really going to be on the duration trade. That, you know, obviously the inflation, the base effects of even the inflation numbers and the supply side issues, where we do have some structural short-term supply side issues, that's going to boost inflation and bring rates up. So at the moment, if you look at the balance of our portfolio, we're between 45 and 50%, very short dated, 1.5 year duration corporates, some bonds, which we think, as Killian mentioned, will outperform treasuries. But over the summer, I think there's going to be a very, very good opportunity to re-establish a treasury position, as we think treasuries will overshoot on the upside, given the deflationary aspects of debt and zombification for the economy. So I think at the end of this year, potentially we will see a higher interest rates in the US, which means an increase in treasury exposure. But what will also happen, hopefully anyway, and how we think it'll happen, is credit spreads will widen again early next year, which will give us another buying opportunity back into credit. So I think there is a rotation that's going to happen over the next number of months. I think the key for fixed income investors is don't get overexposed to the duration trade, certainly in the US, because I think there is danger that we will see, say, 3% plus on the 30-year and maybe see as high as 225 on the US Treasuries on the 10-year. So I think it's quite an interesting couple of months. And I think actually, you know, from our perspective, certainly from a fixed income perspective, Luigi, higher yields mean higher returns ultimately. So I think actually, you know, we're building up to a position now where we can actually start entering some higher yields come the middle of the summer, which, you know, will obviously hopefully mean a very, very good end to the year and good performance at the end of the year. So it really is kind of managing that kind of transition from low rates, low duration to a higher duration, and then potentially next year getting into a bigger corporate bond exposure position. So that looks quite attractive, and it looks like that more than likely will pan out that way so far anyway. On the credit fund, it's also quite interesting. Again, by very nature of the type of fund, as you know, Luigi, for a long time, our credit fund, it's in essence a very short duration fund, right? So on average, duration's around 3.5 years. And if you look at what the Fed's saying now, which we believe, that they'll be cutting QE programs way before they start raising interest rates. So having a 3.5-year duration, you've really got a lot of protection. I mean, I know some of the 4-year, 3-4-year bonds did trade a little bit negative for a couple of weeks there, just gone by. But in general, that 3-year to 4-year space is well protected on the downside. Also, we're buying into the type of credits that are going to benefit from this kind of reflation, higher inflation story. So, one of the things is, as everyone who knows the credit fund knows, we've liked financials for quite a while. Financials look quite attractive with the steeper yield curve. Also, very important to note, financials are massively overcapitalized right now. And we're going to see not that much in the way of bond issuance out of banks over the next 12 months. So I think that's from a supply-demand dynamic, banks are going to be very attractive. So, that's also another really, really strong point. So I think for the credit funds perspective, we actually have kind of backed on where over the next number of months, we will see, a higher inflationary type environment where the bonds that we are going to buy are hopefully going to do very well. I think it's very interesting that our credit fund, which is obviously an investment grade credit fund with a short duration, is still able to manage a running yield in dollars now of over 2.5%. And I think actually in an environment like this with a low duration to the fund, that's a really attractive position to be in. If you look at some of the long dated credit funds out there, they don't even yield that much. So looking at things like, lower tier 2 banking debt, etc., which is very well protected right now, given their structure and very short duration profile, that kind of carry we think is actually really attractive. And from our perspective, that fund will start rolling out some of those positions at the end of the year, which means we might be able to rotate into, say, maybe some other industrials, etc. But mining, banking, things like that, PHP Billiton we bought a couple of months ago at over 6% yield. We think they're very attractive plays. And I think, by the end of this year, we'll have a lot of cash again coming in as bonds are maturing, which means that we get a chance to rotate into higher yields. And that's really the nature of that fund, where with such a short duration profile, you're always having a lot of cash rotate into laddering into higher rates. So a higher rate environment has actually been always very attractive to a fund like this. So if you remember at the second half of 2016, when we had a big jump in rates and stuff like that, this fund has performed very well in those type of scenarios. So really, for the people who are kind of nervous on the duration side, the credit fund, I think, is one of the few funds out there that is very attractive because of its kind of global nature and low duration profile. I think the thing about the GFI fund, Luigi, is that it still is the only fund that we know of right now that still has a negative correlation to equities, right? So it still has a low correlation to risk assets in general, even though we do own risk assets in the fund, just the way we've managed it over the last number of years. And again, it's one of the few funds that show a negative correlation to the broader fixed income space, which is highly correlated with this QE programs, etc. So I think the funds are generally very well positioned over the next 12 months as we're seeing more volatility. And even in both cases, a rise in interest rates will really benefit these funds because they're both fairly got short duration profiles right now, looking to extend our duration later. And that's a function of the credit cycle. I mean, I've talked about this to a number of clients for quite a while over the medium term, which is that over the credit cycle, people tend to take on worse credit and higher and longer duration. Right now, if you look at the breakdown of the type of credits that people are issuing, the type of credits people are buying into their big funds, and the type of duration they're taking on, there's a real combination of long duration and really poor quality bonds that have been issued over the last couple of months. And if you look at the scale of the leverage in the credit markets, if we have another credit event which, don't forget, we've had one every 2 years for the last 10 years. And I was watching an interesting documentary last night on the housing crisis and in the build up to it. And I found it very interesting because everyone kept saying in the build up to the housing crisis, house prices don't go down, house prices don't go down. I mean, I'm sick of every 2 years, in the middle of every 2 year period, people saying credit spreads can't widen again. And what happens? They widen again. It happened in 2016. It happened in 2018. It happened in 2020. People have to understand, there is nothing keeping things fundamentally overvalued over the long term, right? In the short term, sure, it can happen and has happened. But I do think that, when growth does disappoint, that'll be a target for credit spreads to widen. And I think we're going to get great opportunities in that space as well for the likes of GFI. So we don't want to be owning long dated credit today because there's no credit spread upside. So there's no more spread compression that's available because spreads are already at rock bottom. And really, if you look at the performance of the large IG funds this year, for example, they're very highly correlated to the treasury market because it's all a duration trade right now. So credit is no longer a credit trade. It's actually a duration trade. And that's something that we're not attracted to. Now, later in the year, that fund will become a credit trade again, which could be a very negative thing because credit start to widen because, as I said, credit spreads are already as tight as they can possibly be. So I think the idea would be to stay away from long dated credit, certainly, because I don't think that extra 50 basis points of yield you get basically gives you any insurance against the potential downside risk, even just on the duration trade, let alone a credit spread widening situation.
Thank you, Steve. I have a question. So for the last 12 months, we have seen a rotation of of capital moving out of fixed income into equities, which was going through the roof every day. Now, within the fixed income side, we have seen also some diversifications in longer duration funds, in inflation-linked funds, in convertible funds. Do you think that this next quarter is the quarter where an investor should review their allocation related specifically to rubrics and let's say starting to go either neutral or overweight, or is still early? What is your suggestion here?
Well, look, I just mentioned that very important point, Luigi, that you mentioned about people rotating to more risky assets. And, from the reflation perspective, we saw a few surveys where, people's bullishness over the last number of months, certainly in January and February, was at all-time high. And their bearishness on bonds was also at the lowest point on record. So you had this really extreme view that people were massively bearish bonds and massively bullish equities. That situation, as everybody knows, never stays for any length of time. I mean, you could have a situation like that for 6 months, maybe 9 months, but the reality is the world is always somewhere closer to the middle of that. For our view right now, we think that rates will just slowly grind higher over the next couple of months. We like the carry that the credit fund has in the fund. We think 2.5% carry is, I know it doesn't sound that exciting, but in this world right now with a low duration, high credit quality, we think that's not a bad place to be, certainly relative to what you get generally in anywhere else in the credit space right now. But I think coming closer to midsummer, when rates probably start to top out, I would start weighting more towards GFI, because the first really attractive trade, I think, in fixed income we're going to see this year will be a rates trade. And then we'll end up getting to see a credit trade later next year. So for the time being, I think the credit story and the high yield there is quite attractive. But I think coming to the middle of the summer, end of the summer, I think the rates trade will start to look attractive again as growth starts to top out. And that risk of, unfortunately, growth starting to disappoint even in the US late in this year, early next year, will be really much one where we'll see rates start to kind of go down. And very similar to what we saw in 2018, to be honest with you. If you remember everyone's bullishness in January 18 and everyone was very bearish on bonds, at the end of the year, bonds actually ended up outperforming risk assets in 2018. And everyone said that was an impossibility in January. I think 2020 2021 is going to be quite similar to 2018, except the peak of growth and peak of inflation will probably be higher this year than it was in 18, just because the sheer scale and the pent-up demand of COVID. But coming to the later part of the year, that'll kind of unwind itself pretty quickly, very much like it did in 2018. The only concern that we have, guys, in terms of your overall asset allocation is, let's say COVID continues to be an issue for longer, right? So what we're assuming is by the summer, by June, July in the US, things will have pretty much opened up, that they'll go. I mean, the story is by the end of April, by the 1st of May, according to Biden, every grown-up adult in America who wants to have a vaccination can have one, right? I think in Ireland, I think it's about 2024 before we're going to be allowed to have a vaccination, but certainly in the US, my only concern is for our strategy is, what happens if that date gets pushed out? Say there's a supply issue with the Pfizer, there's another supply issue with Moderna, whatever else, and they can't roll it out. Or for example, in the US, you've got a lot of Republicans who will say, I don't want to take the vaccine, it's there to control me, or some rubbish like this. That becomes more problematic, okay, for everybody, and certainly from a strategy. So that means that the markets could probably move sideways for longer because of that, because we're still waiting for it. I think our preference would be, let's open up now, let's have the boom over the summer, and then that will burn itself out pretty quickly. If you don't have a boom, then that money staying on the sidelines will probably stay on the sidelines for longer, waiting to happen. So inflation won't get higher quicker, will happen more slowly. So the only thing I would say about our strategy is, there's a chance that our strategy, which we see it being a 12-month strategy, could actually turn out to being an 18-month strategy, just because the rollout of COVID is more complicated. But as it stands today, and the vaccine rollout in the US being as successful as it is, it looks like we're looking at a strategy that will work for duration and credit over the next 12 months as opposed to 18. But, you know, as I said, we're watching the numbers. We saw what happened in Germany. You know, Ireland's numbers are going up quite fast, even though we're still in lockdown. We've gone from an average of 500 cases a day to 750. So the Irish government is now looking to push back on opening up. We saw what's happening in the UK. I think travel in Europe is going to be problematic over the summer because we just don't have enough vaccines. So, you know, there's going to be delays elsewhere, but in the US, we are hopeful that we do have that summer boom, which in our case would hopefully mean that certainly things like rates would certainly start to meet their highs, which makes them look attractive again.
Okay, thank you. And we have noticed that the non-performing loans have started to grow again. Yeah. Do you think that would potentially could capitulate in a disaster, or do you think that NPLs can be quite contained both in Europe and in the US?
I think they're going to be contained. Very interesting. I think it was last week after the ECB meeting. Now, Killian might know better about this, but there was a private meeting held with their concerns about non-performing loans, that how this could actually slow things down. And they actually, policymakers don't want to see non-performing loans lifted or going up too quickly because of the potential impact that's going to have. I think the policymakers are going to try to avoid, you know, having these kind of issues too soon. But as Draghi and Rajan said, until we clear out the system can never recover. We saw what happened to Europe for years. You as an Italian, Luigi, knows better as well as the Irish guys do. We sat on a lot of non-performing loans in our banking system for a long time. And actually that in itself was enough to prevent any real growth. So when we had the LTROs programs, and we had all those programs in Europe where we were expecting that to really help lift us off, the thing that kept holding us back was these bad debts, etc., sitting in the system. And by the way, China is in exactly the same situation. But what's really interesting in China is they're allowing things to go bust, right? Bonds are failing on a quite a regular basis. And what's really interesting is, and rightly so, by the way, the markets aren't taking that badly. They're actually taking that as quite a positive development. And as a credit guy myself, I think actually having bad loans go bust to allow better businesses move into that space is actually a really healthy thing. But I do think, Luigi, over the next 12 to 18 months, policymakers don't want to see a big rise in non-performing loans. So I think you'll see a lot of extend and pretend across a lot of sectors. A lot of people will roll over a lot of debt for quite a while before we see it. And people have already done that quite a bit. Like, you're seeing the average duration of obviously the regular bond market go very long, but even on the leveraged loan space, like if you even look at the banking sector, I mean, the average kind of lower tier 2 bond now, instead of being, you know, a 5-year, 2-year to call, they're all 10-year with 5-year to call. As in, everyone is extending out this problem. So Luigi, it is an issue. If we don't sort it, you're never going to have a boom in growth. But I don't think they want to touch that now for at least a year or two.
Thank you very much, Steve. Is there any a question from the floor? Any questions?
Hello.
Hi, Steve.
How are you?
Sorry for the delay. I started the meeting lately. So I have just a very quick question regarding the Federal Reserve policy for the coming months. Do you see any potential possibility that they will do any operational twist in order to prevent the long part of the yield curve to rise?
Yeah, I mean, look,
in not ordinary way.
Yeah, look, honestly, I think they're going to stay on the sidelines till they start seeing a real impact. So for me, as long as the credit markets aren't being affected by it, I think Powell will be quite happy to this happen, right? I think he's also concerned, guys, about financial stability, right? Don't tell me that Powell isn't concerned when he sees things like GameStop going up and down 1,000% every week, right? So it's funny how, you know, he's starting to put a little bit of a top on that type of thing by allowing rates to go up. So as far as I can tell, Powell will stay on the sidelines till it starts to impact credit spreads, and then he's going to go, enough is enough. But at the moment, the only real impact this is having is slightly supporting the US dollar, which is actually a positive ultimately for the US, and it's keeping a little bit of the stupid trading and the, you know, all-time highs happening every day. You know, we've had a few all-time highs, but the risk assets are really trading sideways right now. And I think, if you remember, Killian, was it the January meeting where they had a big discussion about financial stability? I think it was January, the Fed, or was it February?
No, yeah, I think it was January. Yeah, late January.
Yeah, that I think the Fed must be concerned about asset prices, right? They know that the fundamentals are completely out of whack for where asset prices are. So I think this is Powell's way of saying, look, we can keep interest rates low in the front end, we can keep QE happening, but a steeper yield curve is just taking a little bit of the spice, the one-way trade for these risk guys. And you can see how kind of a lot of risk assets have kind of topped out a bit. So I think the Powell will be happy for that to continue as long as we're not impacting the credit markets. And I think that'll be his real kind of view and things. So until you see some spread widening or tightening the credit space, I think he's going to say, look, if the markets go to 2.25, he's happy with that. But there's no chance the markets will take it to 4. I mean, that's just not a possibility given the dynamics we have today. But I think he's happy enough at the moment.
It's tough. I know we did discuss this quite recently. You know, we were talking about potential response down the line. And do you think if you know, conditions do tighten and we, you know, we start to see the spread widening, etc., you know, do you think that the Fed would rather do the, you know, an operation twist, for example, than a YCC?
Oh yeah, I mean, I think YCC is the last thing they want to do, because YCC is one step away from capital control. So yeah. I think an operation twist where, don't forget, guys, you know, they're buying 100. One of the big issues the Fed has, by the way, right now, certainly when rates are going up, is that they're buying, what is it, 40 billion of mortgages a month, right? So they're doing 80 treasuries. There isn't. He doesn't even have to do Operation Twist. He just has to say, I'm not buying mortgages anymore because no one's taking out any new mortgages, and I'm just going to use that 40 billion to buy 10-year, 20-year, you know, treasury. So I think the first thing he'll probably do is move away from the mortgage market and use that money for the treasuries. Then he's going to say, I'm not going to buy as many short-dated bonds, because guess what? All that treasury money coming in from fiscal stimulus is buying up the short dated part of the curve anyway, right? So all that money that's flowing out of the treasury account, a lot of that's finding its way into the bills market and the short dated money market funds. So I don't need to buy that shit. I should just go out. So he's got a couple of steps to go. I think the first thing you'll see is a move out of mortgages into a full treasury load in terms of his QE program, and then the twist, then YCC if things really get out of control. But honestly, I think the way things will pan out is the growth will drive rates down on their own later without him having to do anything extreme like YCC. Certainly a swap from mortgages into treasuries is a likely thing that's going to happen if he starts getting concerned.